Banks are not your friends.
And apparently, crypto exchanges are not your friends either.
That's Alex Mashinsky in The Shirt, founder and CEO of Celsius, one of the largest crypto lending platforms. And on June 12th, his company surprised customers when it unexpectedly announced it was pausing all withdrawals, swaps, and transfers between accounts due to extreme market conditions.
By the end of 2021, Celsius was managing about $2 billion of assets, and 1.7 million people was on their platform. With so much in assets being managed, how can a company like that go bankrupt? And what happens to the 1.7 million people who had their money stacked up?
This year, Bitcoin has lost more than half of its value, and another popular cryptocurrency, Ether, has fallen around 70%.
Celsius' decision to freeze customer accounts has rippled across the cryptocurrency industry. Shortly after its announcement, another Asia-based crypto lender called Bubble Finance announced that it is also suspending withdrawals.
Unlike banks, which are FDIC-insured, crypto lenders like Celsius lack the legal protections that are built into the traditional financial system.
Celsius was not FDIC insured. So if the company goes down, when the company goes bankrupt, you lose your money because it is not backed by the government. Here is a list of the crypto exchanges that are FDIC insured.
And as the crypto market continues to tumble, many users of Celsius and the exchange Coinbase are beginning to wonder, if these crypto platforms go bankrupt, what happens to my assets? Celsius is one of dozens of unregulated lenders and lending platforms that have emerged in recent years, touting high returns to investors who are willing to lend their digital assets.
Celsius promised customers annual percentage yields as high as 18.6%. That's a lot more than customers can get from regular bank accounts today.
Here's how that works.
You know what they say, if it's too good to be true, it probably is. And in this case, it was. So unfortunately, people was just focusing on getting those high yields, and they didn't even think to see that, it could have been a scam, or in the fact that it was just too good to be true. And of course, at the end, they got burned.
Customers deposit their cryptocurrency in the Celsius system in exchange for a yield. This is essentially an unsecured loan. And in order to earn a return, the company lends out assets to other users and puts customer deposits in often high-yield, high-risk, decentralized finance investments. When the system is working correctly, Celsius says that customers can expect approval for their withdrawals within 24 hours. But as cryptocurrency prices continued to fall, customers started to withdraw at a rate Celsius couldn't keep up with.
Celsius does not have enough liquidity, meaning readily spendable cryptocurrency on hand to hand back to the customers.
They didn't have the money on hand to give to the customers that wanted to withdraw. So basically they did as the banks normally do. So when we put our money in the bank lends out our money. So Celsius, in this case, lent out their users' money, but unfortunately, with the market going down and companies taking a huge hit, they couldn't pay the people back their money. So that's what happened.
The company has since hired restructuring lawyers to advise on possible solutions for its mounting financial problems.
One of the financing options included a financial restructuring, meaning that the company could potentially file for bankruptcy.
And if that happens, users could face big losses. According to Celsius's terms of use, users that deposit assets in the Earn service grant the company all right and title to such eligible digital assets, including ownership rights.
We have to remember to always read the fine print. Always read the fine print. There might be some things on there that we may not agree with, and later on comes to bite us in the you know what.
That document also calls out bankruptcy explicitly, saying in the event that Celsius becomes bankrupt, enters liquidation, or is otherwise unable to repay its obligations, any eligible digital assets used in the Earn service or as collateral under the Borrow service may not be recoverable. You will likely not see a line like this in a user agreement for a bank, since most banks are FDIC insured. So what does that mean for users?
Based on Celsius terms of use, in the event of a bankruptcy, customer who deposited cryptocurrencies into Celsius accounts may not be able to get their money back because they would be considered essentially unsecured creditors. And even if they were to file for lawsuits against Celsius, they might not have a great chance of winning that legal action.
Similarly, the exchange Coinbase addressed bankruptcy in its quarterly filings, adding a disclosure based on SEC accounting guidelines released in March.
Coinbase made the disclosure that in the event of a bankruptcy, the digital assets that Coinbase holds for its customers may not really belong to the customers.
Coinbase noted that the new language in its financial report could lead customers to view its service as more risky and less attractive.
Coinbase CEO
I was surprised and taken aback that Coinbase would change its language like that. And I'm hoping that Coinbase will not follow the same road that Celsius, Three Arrows, and the other crypto companies follow, because that's more bad news for us. It might be a bigger issue, but I'm hoping that's not the case.
Brian Armstrong has come out and said that the likelihood of the company going bankrupt is extremely low, and the company is in very good financial conditions, but he made the disclosure just for the purpose of transparency.
Nearly 1 month after the bankruptcy disclosure, on June 14th, Coinbase announced it was laying off around 18% of its workforce. Armstrong said the decision was made to ensure Coinbase's health during this economic downturn. But if a crypto platform like Celsius or Coinbase were to go bankrupt, it wouldn't be the first to go under in that way. In 2014, Mt. Gox, then the largest crypto asset platform worldwide, filed for bankruptcy before ultimately filing for liquidation later that year.
The collapse of crypto exchange Mt. Gox back in 2014 also rippled across the industry. It caused the price of Bitcoin to plummet and brought about, so to speak, one of the first crypto winters in the industry.
A rehabilitation plan for affected Mt. Gox users was not confirmed until last fall. Cryptocurrency as an industry still lacks comparable regulation and protection to traditional financial institutions, but a recent bill looks to change that.
Senators Cynthia Lummis and Kirsten Gillibrand proposed a bipartisan crypto bill dubbed the Responsible Financial Innovation Act, which aims to provide a comprehensive regulatory framework for the crypto industry.
While the bill was released around the same time that Coinbase made its bankruptcy disclosure, it is not in direct response to the platform's announcement. The bill is not expected to pass, and other lawmakers have not signed on to it. As for Celsius, the company is under investigation. The Texas State Securities Board said it has opened an investigation into Celsius over its decision to freeze customer accounts, and is working in conjunction with New Jersey, Kentucky, Alabama, and Washington.
And as we wrap up, it's always important that you do your own research, that you don't believe what someone says, and that you always read the fine print. And if it's too good to be true, it probably definitely is. So be mindful of what you're getting into, and know that every investment or every speculation is a risk, and it's your money and you may not get it back.